Welcome everybody to my Altria stock analysis. I figured I would start with Altria because I thought it would be an easy stock to analyze because this is a very stable business. They sell tobacco products. Not much to it. They sell their Copenhagen and Marlboro brands. Now, the breakdown between these two, their smokable products make up most of their revenue, so that would be their Marlboro brand, and then Copenhagen and their other oral tobacco products make up about 15% of the revenue, and about 85% comes from cigarettes. The other products, they are trying to get into the e-cigarette market, but it seems like it is very difficult for them, being that they have like less than 1% of their revenue coming from that. So the market for cigarettes has been declining for the past however many years, and they are declining at a rate of 2.5%. I just yoinked this slide right off of Altria's pages, and they are predicting a 2.5% decline every single year for cigarettes. And way back in the day, maybe like 2 years ago or 3 years ago, they actually took a 35% stake in Juul for $13 billion. Big mistake, because now Juul is worth about $1 billion, and Enjoy is their other little e-cig brand that hasn't really been making too much money, but it is growing at least, and they just have small revenues from e-cigs. Now let's get into the numbers for them. Let's go over to TradingView. Now TradingView, this is their 5-year chart. You can see their lowest was in March 20th at $34 a share, and their highest was at $56 a share in May of 2022. And right now they're trading at $40.86. Some other things to note is they have a price to earnings ratio of only 9, and their dividend yield is almost 10%. So really, really good yields, and that's why I figured I'd cover this as kind of a value stock and see what it's actually worth. Now, some other things that we want to look at: what is their revenue growth and what is their projected revenue. So coming here to their total revenue, you can see it is very, very stable. It just hovers between 19 and 21 billion pretty much from 2017 all the way to 2023, and I don't really expect that to change very much. You can also see that the cost of goods sold has actually been decreasing. So their margins are increasing, which is a good sign. Their operating income has been increasing slightly. All right. They had, okay, right here, you can see non-operating income, and it's their unusual expense right here. Or wait. Their non-operating income, pre-tax equity and earnings. So that's most likely their loss from Juul, because they spent $13 billion on it, and now it's worth just $1 billion. So they took massive losses on that position, and that's why their income for those years was so suppressed. Their income being only $4 billion, $2 billion, and $5 billion. Whereas if we look at their cash flow has been hovering around $8 billion every single year, and last year they did $9 billion in cash flow. And they basically pay out most of it in dividends. So dividends, they paid out 6.7 or 6.8 billion of that 9 billion. So not a crazily high payout ratio, but pretty high payout ratio. The other thing that I want to note, they are buying back stock. They buy back $1 billion worth of stock every single year, or at least for the last year and this year projected. Let's see here. What else? The balance sheet. Oh yeah, I wanted to talk about this a little bit. Their balance sheet, they do have negative book value because they do have a lot of debt. Now, this is a company that can service that debt, especially for a very long time, because they are in the cigarette business and it's a very predictable stream of income. So the debt, although it is high, I don't really see it as a big problem, but it is going to affect our valuation coming up. So I think that is good for their income statement, balance sheet, cash flow statement. And let's get into the DCF calculation. Alrighty, so this is the spreadsheet that I created. You just type in the ticker and it will load all this information for you. The only boxes that you actually have to change is the boxes that are in tan. So pretty cool spreadsheet here. Let's go through some of the information on Altria Group. Their ROIC is actually much higher than I expected at about 40%, but that is in 2023, of course. Their debt to EBITDA at 1.84, so it's not super high. It's definitely manageable in comparison to their income. Their gross profit margin around 70% and their profit margin at about 53%. So really good profit margins. Their book value is negative. Their 2024 estimates, so they're estimated to go from 8 billion in earnings to 8.9 billion in earnings, which is almost a 10% growth, which is actually pretty high. And then their 2025 estimate is supposed to go up to 9.1 billion in earnings, so a 2.6% growth. Now their revenue growth at 2% and their revenue growth at 0.3%. So their revenue growth pretty much flat and their earnings are growing. And that's according to all of these analysts. So you can see the number of analysts in that calculation, and that's the average that they've come up with. Now we can also look at their historical earnings growth to get a good projection of the future. And historically, we can see their compounded annual growth rate from 2017 to 2023, and then their compounded annual growth rate from 2016 to 2022. The reason why I do two of these is because sometimes there is a wacky number in here that can throw off all of the numbers, so that's why I do it twice for 4 different years, basically, so that we can get a better, more accurate representation of their growth. So we can see their earnings growth pretty much flat here, but then here it's minus 10%. So not good there, but then the revenue growth is higher, barely. Their revenue growth pretty much flat over those years, and their cash flow has actually grown, probably because these two numbers are so low. Otherwise, their cash flow growth has been maybe increasing a little bit, but otherwise pretty flat. Now we can get into the discounted cash flow model or discounted earnings model. I used earnings because it is easier for me to get the earnings projection using the software that I'm using. So I can't get cash flow projections from the analyst, so that's why I'm using earnings instead. Hopefully it doesn't make too big of a difference. So here we've got their growth. We can actually put in their 2024 estimates here. So we could put 9 here, and then their 2025 estimate at 2% here. And then probably they're going to be flat for a while, and then probably like minus 1%, and maybe their terminal growth, maybe we could put at minus 2%. Well, minus 1% sounds about right for the cigarette industry. If you remember earlier in the video, I said that the cigarette industry is declining by 2.5% a year. Well, their revenue stays basically flat, and their margins have been increasing. So I think it is a reasonable assumption to assume that maybe they decrease by just 1% a year and not too much more than that. So we can see that their fair share price is $52 a share, but they do have lots of debt. So if we subtract the debt from the total value of their income, we get a fair value of their stock at $39 a share, which is just lower than the $40 current share price. Now, their debt is manageable and it's serviceable. I don't think that the debt should have this large of an effect on the price. So their fair value is probably somewhere in between this $40 and $52. Probably around like $45. So actually, it is an attractive valuation at this point if we want a 10% return. The other thing, very important in this model, is the discount rate. Um, the discount rate that I put here is 10% because I want a 10% return on my portfolio. And so this is the discount rate that I've been using for all of my stocks. And yeah, that's pretty much it. I hope you guys enjoyed. If you did, hit that like button, and I'll see you in the next one.